They told you the markets were liquid. They told you supply was adequate. But something unprecedented is happening right now, and almost no one is talking about it. The physical supply is disappearing, not slowly, not gradually. It's being drained silently, relentlessly, and globally. And once the physical is gone, the paper markets are next. First, understand what physical supply actually means, because this is where most people get confused. Physical supply is not a price chart flashing green or red. It is not a futures contract rolling over every few months. It is not an ETF share sitting in a brokerage account. Physical supply is real metal that exists in the real world. It is metal that can be held in your hands, weighed, tested, transported, and delivered. It exists in vaults, refineries, factories, and private storage. And right now, that real-world supply is quietly but steadily leaving the system. For decades, the global market has been conditioned to think in abstractions. Screens replaced storage, contracts replaced ownership, exposure replaced possession. As long as the system appeared smooth, no one questioned whether the metal behind the numbers actually existed in sufficient quantity. Prices moved, trades settled, and confidence remained intact. But beneath the surface, the foundation has been eroding. The physical market and the paper market have slowly drifted apart, and now the gap between them is becoming impossible to ignore. Look at the vaults. Official reports, even the carefully worded ones, show historic drawdowns. Metal is being withdrawn faster than it is being replenished. Registered inventories shrink month after month. What used to be considered ample reserves are now thin buffers. And these are not small fluctuations that can be explained away by seasonal demand or logistics issues. These are structural declines, signaling that metal is leaving storage permanently, not temporarily. Once physical metal exits the system and moves into long-term hands, it rarely comes back at the same price, if it comes back at all. At the same time, central banks are accumulating at a pace not seen in generations. This is one of the most important signals in the entire market, yet it is often dismissed or downplayed. Central banks do not chase trends. They do not speculate for short-term profit. When they accumulate physical assets, they do so with long-time horizons and strategic intent. Their buying tells you something fundamental. Trust in paper claims is weakening at the highest levels of the financial system. They want assets without counterparty risk, assets that do not depend on another institution's promise to perform, assets that sit quietly on a balance sheet and remain valuable regardless of policy, politics, or currency shifts. Alongside central banks, long-term private holders are refusing to sell. This is another subtle but critical shift. In past cycles, rising prices would coax metal back into the market. Profit-taking would increase supply, easing pressure. That behavior is changing. Holders are no longer motivated by short-term price moves. They see the bigger picture. They understand that replacement is uncertain and future availability is questionable. Selling now may mean being unable to buy back later, regardless of price. When owners stop responding to price signals, the market loses one of its main balancing mechanisms. Industrial demand only adds fuel to this pressure. Unlike investment demand, industrial demand is not optional. Manufacturers cannot substitute wishful thinking for raw materials. Technologies that underpin modern life energy systems, electronics, medical equipment, infrastructure, require physical inputs. As global electrification expands and technological complexity increases, the demand for certain metals rises structurally, not cyclically. These industries do not care about futures curves or ETF inflows. They care about delivery schedules and material availability. When supply tightens, they compete directly with investors and governments for the same finite resources. Now consider the supply side, because this is where the illusion of abundance completely collapses. Mining is not a tap you can turn on. New production does not respond quickly to higher prices. From discovery to permitting to development to full-scale production, mining takes years, often a decade or more. Even expanding existing operations is capital-intensive, slow, and increasingly constrained by regulation, environmental concerns, and geopolitical risk. Declining ore grades mean more effort and cost for less output. Easy supply has already been extracted. What remains is harder, deeper, and more expensive to reach. Recycling, often cited as a solution, is limited by reality. You cannot recycle what is not available. Much of the metal used in industrial applications is dispersed, embedded, or lost over time. Recovery rates are far lower than people assume. Recycling helps at the margins, but it cannot replace primary supply, especially in periods of rising demand. It is a supplement, not a substitute. So what's being removed from the system is not being replaced. That is the core problem. Every ounce withdrawn from a vault, every ton locked into long-term storage, every shipment diverted to strategic reserves tightens the market further. Yet the surface-level indicators tell a different story. Prices remain subdued. Volatility looks contained. Analysts point to ample supply based on paper metrics. This creates a dangerous disconnect. The market looks stable because paper prices say so, but those prices are increasingly divorced from physical reality. paper prices are shaped by leverage, liquidity, and sentiment. They reflect how contracts trade, not how scarce the underlying asset has become. As long as paper claims can be created freely, they can suppress the signal of scarcity. But paper cannot create metal. It can only create promises. And promises only work until enough people ask for fulfillment. The physical market, meanwhile, is sending clear signals. Premiums rise even when spot prices fall. Delivery times stretch. Allocation replaces immediate availability. Buyers are told to wait, to accept alternatives, or to pay more for certainty. These are classic signs of scarcity, even if they don't show up neatly on a chart. The tension builds quietly, often ignored by those focused solely on financial instruments. This is why understanding physical supply is so important. It forces you to step outside the abstraction and look at the system as it actually exists. A market cannot function indefinitely when the real asset is draining away while claims multiply. Eventually, something has to give. Either supply increases, which current conditions make unlikely, or the structure built on paper must adjust to reflect reality. And that adjustment is rarely smooth. It tends to happen suddenly, after long periods of apparent calm. The longer the imbalance persists, the more violent the correction becomes. What looks stable today may simply be the calm before a repricing driven not by speculation but by necessity. The physical market is not whispering anymore. It is screaming scarcity. The only reason many don't hear it is because they are listening to the wrong signals. Second, paper markets only work as long as people believe they can convert paper into reality, and that belief is far more fragile than most participants realize. Futures contracts, derivatives, options, swaps, and unallocated accounts are not backed by piles of metal sitting idle, waiting to be claimed. They are backed by confidence, netting mechanisms, and the assumption that most holders will never demand physical delivery at the same time. The system is designed around probability, not certainty. It assumes that paper will circulate, roll over, or be cash settled long before anyone asks for the real thing. For every ounce of physical metal that actually exists in accessible form, there are dozens, sometimes hundreds, of paper claims layered on top of it. This leverage did not arise by accident. It was created to provide liquidity, enable hedging, and keep markets efficient. On paper, it works beautifully. Prices are discovered quickly. Volatility can be managed. Large volumes can trade without moving the market too violently. But this efficiency comes at a cost. The paper market grows detached from the physical foundation it is supposed to represent. As long as physical supply is abundant, this detachment is mostly invisible. Few people feel the need to test the system. Why demand delivery when rolling a contract is easy, cheap, and profitable? Why insist on physical ownership when exposure delivers similar returns with less friction? Confidence remains high and the structure holds, but this stability is conditional. It relies on the quiet assumption that physical supply will always be there if needed, even if it is rarely needed. When physical supply begins to tighten, that assumption starts to fail. At first, the cracks are subtle. Delivery times lengthen slightly. Certain contract months become harder to source. Premiums begin to creep higher, even as headline prices remain calm. Market participants rationalize these signals as temporary disruptions or logistical hiccups. But beneath the surface, something more fundamental is happening. The margin for error is shrinking. Paper markets are not designed to handle widespread delivery demands. They are designed to net out positions. Longs and shorts offset each other. Contracts expire and are replaced. Cash flows settle differences. Physical delivery is the exception, not the rule. When too many participants move from speculation to ownership, the machinery strains. Clearing members scramble. Warehouses draw down inventories. The system shifts from routine operation to damage control. This is when delays start. Delivery windows are extended. Force majeure clauses are quietly invoked. Participants are encouraged to roll contracts forward instead of taking delivery. Incentives are offered to accept cash settlement rather than metal. These measures are framed as temporary adjustments, but they reveal the true nature of the system. When paper meets physical scarcity, paper bends first. Premiums are often the loudest alarm. While spot prices may remain suppressed by heavy paper selling, premiums in the physical market can explode. This divergence confuses those who believe price is the final truth. But price and availability are not the same thing. A low paper price means little if metal cannot be sourced at that price. Premiums rise because sellers demand compensation for parting with something scarce, and buyers are willing to pay for certainty. This is the market's way of reconciling two realities that no longer align. Cash settlement replacing delivery is another critical signal. On the surface, it appears harmless. After all, money is money, and profits are profits. But the shift from delivery to cash is not neutral. It marks the moment when the market admits, implicitly, that it cannot fulfill all claims as written. The promise changes. What was once an obligation to deliver metal becomes an obligation to pay. That distinction matters deeply to anyone seeking protection from currency risk, inflation, or systemic instability. Cash settlement preserves the appearance of order while quietly redefining the contract. Rules changing is perhaps the most underappreciated aspect of this process. Market rules are not laws of nature. They are frameworks written by institutions to maintain functionality. When stress increases, those frameworks can be adjusted. Position limits are altered. Delivery requirements are modified. Definitions of eligible metal are expanded or narrowed. None of these changes are announced as failures. They are presented as prudent risk management. But from the perspective of the holder expecting physical delivery, they represent a moving target. This is not a theoretical scenario. History offers clear examples of paper markets under stress when physical demand overwhelms supply. In multiple instances across commodities and currencies, paper claims far exceeded deliverable inventory. The response was rarely an orderly repricing. More often, it was intervention, restructuring, and rule changes designed to buy time and prevent outright default. The system survived, but not in its original form, and not without cost to those who misunderstood what they actually owned. When physical demand overwhelms paper promises, the paper market does not gently correct to reflect reality. It breaks in stages. First comes denial, then delay, then modification, and finally repricing, often after the most important opportunities have passed. Those relying on paper exposure are forced to accept outcomes they did not anticipate. Those holding physical assets operate under a different set of rules entirely. The core weakness of paper markets is that they conflate liquidity with supply. High trading volume creates the illusion of abundance. Tight spreads create the illusion of accessibility. But liquidity can vanish overnight when confidence falters. Supply cannot. It either exists or it does not. When participants realize that claims outnumber reality by orders of magnitude, trust erodes rapidly. At that point, behavior changes. Investors who were content with exposure seek ownership. Hedgers who assumed easy delivery become anxious. Institutions reassess counterparty risk. Each shift increases pressure on the system, accelerating the very outcome everyone hoped to avoid. The feedback loop tightens, and what once seemed unthinkable becomes inevitable. Paper markets are powerful tools, but they are not foundations. They are layers built on top of something real. When that underlying reality becomes scarce, the layers cannot support their own weight. The breaking point is not announced in advance. It reveals itself through stress, exceptions, and quiet rewrites of the rules. And by the time the break becomes obvious, the advantage has already shifted away from paper and toward the physical reality it can no longer fully represent. Third, when paper breaks, price no longer matters, availability does. And this is the point where everything most people believe about markets is turned upside down. For years, participants are trained to think that price is the ultimate signal. If the price is low, supply must be abundant. If the price is high, supply must be tight. But this logic only works in a functioning paper system. When that system fractures, price loses its authority. What replaces it is something far more primitive and far more powerful: possession. At this stage, the market stops being about the spot price displayed on a screen and becomes about who actually has metal in hand and who does not. Transactions no longer reference a universal price. They are negotiated case by case. Availability, location, form, and timing matter more than benchmarks. The idea of a single global price begins to dissolve because different buyers face different realities. Someone with metal ready for immediate delivery holds an advantage that no chart can capture. This is when price disconnects from reality in the most dramatic way. Paper prices may lag, freeze, or even fall under forced selling and intervention, while real-world transactions occur at levels far above the official quote. The gap between what the market says something is worth and what people are actually willing to pay to secure it widens rapidly. Observers who rely solely on financial data are confused. They see calm where there is chaos and stability where there is stress. The real action has moved off screen.